Over the past few weeks, financial markets have seen significant bouts of volatility due to the ever-changing events surrounding the coronavirus. Investors are no doubt concerned about the sharp falls that we have witnessed in global equity markets and the inevitable uncertainty and risks that the UK and global economy will face. Global leaders are facing some of the most difficult social and economic decisions witnessed in generations. This presentation will focus solely on the economic impact caused by the coronavirus so far and the expected further disruption over the weeks and months ahead. The exponential rise of the novel coronavirus has led investors to ask just how much more financial turmoil can be expected. First, we will look at how financial markets have performed over the past few weeks, before moving on to look at how central banks have responded from a monetary and fiscal stance, and the impact that this could have on markets. We will then explore the implications these events may have on DB pension schemes in the UK. We will first review initial market reactions to the outbreak of the virus, looking at both developed market equities, fixed income assets, and oil prices. Equity markets around the world have witnessed some of the most dramatic falls since the global financial crisis in 2008. The FTSE 100, for example, a measure of the top 100 firms in the UK, saw intraday falls of around 11%, whilst the S&P 500, a measure of the top 500 firms in the USA, saw falls of around 10%. The chart shows the FTSE 100 and MSCI World, a proxy for global equity markets over the 2019 period to 16th of March 2020. 2019 was somewhat of a positive year for equity markets, with both the FTSE and MSCI World up around 17% and 30% respectively. As we entered 2020, investors around the world began to take note of the events taking place in China and waited cautiously to determine if the threat of the new virus would be contained and the economic impact it could have on global economies. It became apparent relatively quickly when investors began to see the drastic measures being enforced in China. Year to date, 17th of March 2020, the FTSE 100 is down around 30%, whilst the MSCI World is down approximately 25%. At the same time, bond yields around the globe have also seen a sharp decline as investors flee risk-seeking assets, increasing the demand for safe haven assets, in turn driving yields lower. The over 15-year gilt yield fell as low as 0.5%, whilst the over 5-year index-linked gilt yield fell further into negative territory as low as minus 2.9% on the 9th of March 2020. A fall in gilt yields, all else being equal, would normally see a UK DB pension scheme's liability increase. However, over the past couple of days, investors are pricing in the risk of a surge in government borrowing to fund stimulus aimed at offsetting the economic shock caused by the pandemic. This has caused both nominal and real yields to rise. In the midst of the coronavirus outbreak, investors have been dealt another potential blow. The price of Brent crude oil has suffered major falls as Russia and OPEC failed to agree a proposed cut in supply, which was intended to match the virus-driven cut in demand. Saudi Arabia, OPEC's largest member, launched an all-out price war with Russia, pushing the price of Brent crude oil below $30 per barrel, prices not seen since 2016. Currently, the question is how long can either party sustain these low prices? Many energy experts suspect the break-even price for oil, even for Saudi Arabia, is actually as high as $80 per barrel. Energy-heavy benchmarks in the UK have been hurt, and share prices of UK oil giants Royal Dutch Shell and BP have taken a major hit. Yet there are some beneficiaries to the fall in oil prices. Major oil-consuming countries such as India, Germany and China could see some relief from the fall in price. Investors' uncertainty can be gauged through volatility in financial markets. Volatility is a measure of the magnitude of price movements over a certain period of time. The best-known measure of market volatility is the CBOE Volatility Index, or more commonly known as the VIX. The VIX index measures implied volatility in the S&P 500 over the forward period of 30 days. It is important to note that the VIX is not a measure of actual volatility, but rather the expected volatility that has been priced into option contracts. The VIX is also known as the fear index, or fear gauge, as we can directly view the market's expectation of future volatility. The long-term chart of the VIX index on the left-hand side shows large spikes in the index at times of great uncertainty. For example, in 2008 with the Great Financial Crash, 2010 with the Flash Crash, and 2011 with the S&P downgrade of US sovereign debt. As a rule of thumb, a value lower than 20 represents a low-risk environment, and values above 30 represents a high-risk environment. On the 16th of March 2020, the VIX closed at a record peak of around 83, emphasizing the market's current heightened uncertainty. Policymakers around the globe have been forced into drastic measures in the attempt to stabilize markets. The next few slides will highlight some of these measures taken. The impact of the coronavirus has led many market analysts to conclude that recessions in leading global economies are inevitable. Indicators are clearly pointing towards a severe slump in Q2 consumer spending and manufacturing. We will look at the economic response both in terms of fiscal and monetary policy and how these responses are filtered down to investor sentiment. It can be argued that in response to the current environment, financial markets have acted somewhat rationally. Equity markets have fallen dramatically, whilst the perceived safer assets such as government bonds have rallied. The chart shows the disparity in returns between the MSCI World Index and the Government Bond Index. Year to date, 17th of March 2020, the MSCI World is down approximately 25%, whilst the over 15-year total return Government Bond Index is up around 8%. Since the outbreak began in Wuhan, China at the start of 2020, the Chinese authorities took unprecedented measures in the attempts to contain the virus. These measures came at great economic costs. The Chinese economy, in particular the manufacturing sector, came to an abrupt halt at the start of Q1 2020. The lockdown will have hammered service spending, though no doubt exports too. After around 12 weeks of social and economic turbulence, there has been some progress made in China, albeit very slowly. Chinese infection rates have begun to fall, and manufacturing activity has slowly started to pick up. However, it is important to note that the return to work in China has been very gradual, and it is unlikely to be complete by the end of this month. As the virus spread out of China and into Europe, European governments have been faced with the same adverse social and economic conundrums seen in China. The Eurozone bloc's economy risks a 2 to 2.5% hit in GDP as a result of this outbreak. It is now clear that the global economy is at war with this virus. Italy so far has been the worst affected area outside of China. Northern Italy, often regarded as the economic powerhouse of Italy, has seen catastrophic economic impacts from the virus, with bars, cafes, restaurants and hotels all closed. On the 9th of March 2020, the Italian government took the unimaginable step of putting the country into lockdown. The economic impact of Italy's lockdown is estimated to hit tourism and transport activity by around 90%. The retail industry by around 50%, and the factory output by about 10%. The Italian government has said payments on mortgages will be suspended across the whole of Italy, with Italy's banking lobby offering debt suspensions to small firms and households grappling with the economic fallout of the virus. These measures have been rolled out across other countries in the Euro area, including Germany and France, with the UK government expected to step up the level of draconian measures over the coming weeks. Spanish ministers have stated earlier this week that the state of emergency over the coronavirus, which has shut down much of the country, will have to be extended beyond an initial 15-day period. EU borders have imposed a 30-day ban on travellers from outside the EU in an attempt to halt the spread. However, such measures will only exacerbate the economic impact in the euro area. As the spread of the virus increases at an exponential rate, it is becoming evident that the governments across the world are struggling to contain the spread. The current environment has called for rapid emergency responses from central banks around the globe. The Federal Reserve has twice cut interest rates. On Sunday the 15th of March, the Fed moved to a target rate of 0 to 0.25%. Fed Chairman Jerome Powell has also announced a quantitative easing program of at least $700 billion of asset purchases in a hope to keep liquidity levels in the US economy sustainable. The European Central Bank, the ECB, have elected to maintain its refinancing rate and deposit rate at 0 and minus 0.5%, indicating that these tools have run its course and that plunging further into negative territory would not be beneficial. Instead, they have announced a new temporary long-term refinancing operation, more favourable terms to the existing targeted longer-term refinancing operation, and a boost to their quantitative easing programme, unveiling a €750 billion bond buy and purchase. Closer to home, the Governor of the Bank of England launched emergency credit measures to prevent a wave of corporate bankruptcies, cutting interest rates to 0.25%, a cut, arguably, that had already been priced into markets. New Chancellor of the Exchequer, Rishi Sunak, unveiled a package of financial measures to stabilise the UK economy against the coronavirus impact. These included £330 billion worth of loans to help companies big and small combat expected cash flow issues, $20 billion in other aid, including grants targeting companies in the retail, hospitality and leisure industry. Business rate holidays and help for airlines is also being considered. Trustees of UK DB pension schemes are inevitably concerned with the recent market moves. However, it is important to remember that one of the biggest advantages for institutional investors is their long-term investment horizons. The chart shows the recent fall in equity markets relative to a much longer-term time frame. Trustees should seek comfort in their ability to weather such storms. Drastic government and central bank policy have been implemented to try and stabilise markets. Whilst only time will tell how equity markets will react to such measures, these increased bouts of volatility is expected to remain until coronavirus fears subdued. Now, arguably more so than ever, trustees of UK DB pension schemes should understand the benefits of a diversified portfolio. Markets have entered into a wait-and-see phase as to whether the shift in market sentiment is temporary or if what we are witnessing is more of a structural shift. The current economic landscape will inevitably lead to market opportunities. However, protection of assets over the coming weeks and months ahead should remain at the forefront of investors' thinking. Thank you for listening. We hope you and your family are staying safe during this volatile and uncertain period.